We are in the second quarter already. I'm like shocked, legitimately shocked we're already in the second quarter. It has been a very, very busy year and self-storage is on a tear. So I wanted to give you a quick update and give you what we're seeing, what we're doing, and why. I think these are important because times seem to be changing really, really quickly. As last year came in, we made a lot of changes within our organization as far as hiring goes, but we also changed a lot of the deals we were doing and how we were doing it. We took advantage of some of the things in coronavirus with the economy shutting down by acquiring some great deals right at first when we saw the CMBS markets shut down, as well as other things. And it worked out really well to take an opportunity out of a horrible, horrible situation. But we were very concerned, right? So obviously everybody was concerned. I'm not saying that concern's gone, but it happened so quick, as everybody knows, that we made a lot of dramatic changes. As we purchased those properties, we analyzed markets that were doing good and bad, and we started to really shift around and became much more hyper-focused on markets individually that we would think would do amazing in the long term. This has not changed. We are very picky right now. With that said, we're doing a ton, a lot of deals. We have 7 deals over 1 million square feet under contract at this moment. Of that, I'm very confident of 60% right now. I'm extremely confident. Conversions, new builds, and acquisitions. Which one are we doing? All of them. So we've acquired another office building. We have multiple ground ups, and we have 3 that we are buying and turning around. Now, when we're looking at deals, the good, the bad, the ugly, right? Where are we going? Where are we headed? And why are we making the decisions that we're making? This is what I wanted to ask operators when I got started. Why are you doing what you're doing? And how could I use that right now in my business? If I want to go out and I want to acquire a storage facility, what are the big guys doing? What are the medium guys like me doing? And what are the small guys doing? Generally speaking, we see a trend right now towards development. That has been going on for years. Anyone in storage knows that. It's been astronomical. One of the reasons, though, driving this is super high prices. Coronavirus opened up the floodgates of government stimulus and money coming in. Money is cheap, and it's everywhere. Everyone wants to invest. But in the United States last year, like in 2008, we had another, what I would say, really golden goose. It's been such an interesting time in real estate investing in my lifespan. I feel like 15 years ago, since then, these golden goose, right, of real estate that just were asset classes that were never going to end. They were always good, and you couldn't even question them. Housing prices don't drop, right? Retail is as stable as it gets. Some of these fundamental things that we understood in real estate were just obliterated in the last 15 years. And I feel like coronavirus did that again. It gave us another punch to the real estate market where we started analyzing sectors of the economy in ways that we'd never analyzed them. Even in apartments, you mean we may not be able to collect rent from our tenants? Retail, which was already struggling, really, really hit hard. Hotels, right? All these different uses of real estate, like commercial, not in retail, but commercial when you're looking at services, now got tested, event centers, and there was just so much going on. But self-storage did good. That put even more pressure on self-storage when so much pressure had been put on it after 2008. Going into the second quarter, we see that. So we think that by changing our strategy and getting access into good markets that have a lot of upside, that are very underserved, is our best play. We're still identifying and we still acquire underperforming facilities. That will never, ever not be a part of our playbook. We have 3 facilities now. I'm hoping we even get more. I'm really trying to end up this year with over 1 million square feet. By the way, if you want to see our deals, go to cedarcreekwealth.com. Go in there, send an email. We'll get you a list of our deals and what we're doing. But our strategy from last year continues to this year. It's really not changing. We're really focusing on fundamentals, though. Hyper focused on local markets and where we can take those assets. As far as the future goes, we're right now living on the government. All of us, everybody is. The economy is, right? I don't know where that's going to end up. Nobody knows. We've never been in a situation like this. It's just, every day you open up the newspaper and it's another $3 trillion are going to be given to the American people. And unlike times in past where you had the Great Depression, they built not only infrastructure, but they built factories. They trained workers. Now they're just sending checks to people so we can buy cell phones and TVs. It's just not happened like this before. Coronavirus has helped occupancy amongst storage. We've seen it. Why? Low rates, housing prices drive up, people are moving, great migrations. I'm looking at what interest rates right now that are starting to rise because of inflation are going to do to those markets in that storage facility sector. That's the danger. That's where we're looking at it in the future here. We already see the yield of the bonds are starting to rise. All this money, all this free money, and we just got reports today that we're at 6% unemployment. They were expecting 300,000 new jobs, and it was like 700,000, right? This all screams to us inflation, which means interest rates are going to rise. If interest rates rise, what happens to housing? Can people still move? What happens to the cost of RVs and other things that people store? When we're looking at markets, I'm trying to understand how they're going to be affected in those kind of situations. I need there to be a margin of safety, and that's what we're looking for. My margin of safety is my upside. I talk about this a lot, right? I talk about the money on the table. When I'm buying a facility, where's the money on the table that this operator's just left sitting there that he didn't know that was sitting there or just didn't know how to get it off the table that I can come extract immediately? Like Warren Buffett has his margin of safety, that's mine. I want to see that because I need to have good returns so if things go south, I'm okay. Cash flows are high, we bought it right, and we can ride through a couple bad years. Stress testing right now is really important, which, by the way, it was April 1st, yesterday, to give context to this video, so we make sure that we know what we're talking about, 2021. Now, this changes so much. This changes a lot, but all our investments that I'm buying, I'd buy today, tomorrow, and years moving forward. That never changes. That will always remain consistent. I'm trying to find good cash flowing deals in great markets that will cash flow, keep me, my investors, protected, and make us a great return no matter what happens. That's always our focus, and that's still our focus today, but we are being more careful about what we buy than we have in the past because we do see upside is more limited. Operations are key, and we are being very strategic on how we employ our strategies over these assets in these markets. Like, how are we going to get those individual rates up? So we're doing a lot in underwriting that I think is really cool, and we'll share with you in another video. But with that said, this is my YouTube. I'm trying to be transparent as possible with you guys in the self-storage world. I want this to be a real-time conference, a state of the market that you guys don't have to wait and hear from later on, but you can see from us the mistakes and what's happening. If you like this, please give me a thumbs up, subscribe, leave a comment. Now, with that said, in the second quarter of this year moving forward, we're ramping up deals. I wanted to talk a little bit about how we're building. When we're building storage facilities and where we're building, we are very, very concerned about overbuilt markets. There tends to be more of those today than there has been because of the building cycle that we're on and with that rise of interest rate. I already went over that. But we are looking at markets in general that have a pipeline of population growth with stagnant square foot per capita growth on the storage side. That doesn't mean, though, I'm building for tomorrow. And that's what I want to talk about. I don't build so in the future, we'll make good returns. I only build where the demand will already be enough to fill in that square footage of whatever I'm building. And I look at markets that I can analyze that easily. So in a small market, that can be really hard. If you have a market that has 2,000 people and you build 200 units, that's a huge change to that marketplace because only 10% of the population uses storage anyways. So your effect on where in the markets that you build, I look at the impact. So my facility that we're going to build in this market, what impact of supply and demand does that have? Will that impact be saturated by today's demand? As in, could I put that on and there's already enough demand today? I don't want to speculate. I don't want to, if things keep going, this will be great. That's what we avoid. Those are the markets we're building in, and that's how we're analyzing. We have another video on exactly analyzing markets. Check it out. I hope that was helpful, guys. Second quarter, we're going strong. It's going to be a great year. Thanks, everybody.